We are very grateful to have two enormously distinguished investors sitting in distinctive positions in the market, but I think just from talking earlier, share some of the same investing philosophy. We don't have very much time. I know there's great interest in how you approach investing in this environment, extreme short-term volatility, lots of noise, but also some structural long-term forces, not least the trends that are pushing up the cost of money relative to the last few decades. I want to talk about how you're approaching investing with your distinctive portfolios and approaches, but I know there's also great appetite for getting to where that exactly is leading you on some of the practical opportunities you see, so I hope we're going to have time for both. But Sheikh Saoud, you have quite recently become managing director of the oldest sovereign wealth fund, the KIA. Tell me something about how you think about portfolio construction in this environment.
Thank you very much, Stephanie, and it's great to be here today in Doha. And you said something about starting with noise. I would start off by saying, ignore the noise. If you're a long-term investor, ignore the noise. And how we look about global opportunities, we're going to talk about today about identifying opportunities based on mismanagement of risk. And as a long-term investor, you can't be lucky. In order to be successful, you just can't be lucky. Someone can be lucky in the short term, but over the long run, you can't afford to be lucky. And to successfully identify opportunities, you need 4 key things. You need to have a long-term strategy. You need to put a process around it. You need to surround yourself with the talent to pick the right opportunities. And you need to have the guts to make bold decisions when opportunities arise. And as a long-term investor going into portfolio construction, whether you're a sovereign wealth fund or a pension fund, you need to know where you're going, reverse engineer it, and you'll have a return of capital on average that you need to achieve. But that's where the main problem is, because investors sometimes tend to focus on chasing returns, but not looking at risk. So you have to assign a specific risk profile to your investment. And the perception is the more risk you take, the more likelihood of a greater return. But that can be deceiving. You can't avoid risk when investing. You need to understand it and know how to manage it. And risk can be deceiving because it's always an absolute number. It's always positive. But the more risk you take, the more the likelihood of a greater return. But the flip side is also true. The more risk you take, the more the likelihood of a lower return. And that's why you need to put a process around it. Because investing is rational, investors are not. And you need to eliminate emotions when investing, and we've seen that in the 6 months of this year. You've seen very volatile markets. You've seen animal spirits come at the beginning of the year, but they went into hibernation. And we've seen it change. And you'd think that word is upside down, but it probably isn't, and probably Howard has to say a few things about that.
Howard Marks. Well, you know, this panel's kind of rigged because we agree so much. But, you know, the essence of investing is appropriately bearing risk for profit. If there's no uncertainty, you're not going to get paid very much. And as Sheikh Saoud says, you want to have the right mix for your risk tolerance, but you also want to be aware in a long-term sense of where risk is being mispriced, and thus where you can get superior risk-adjusted returns without actually taking too much risk. And, you know, the last 15 years have been a very rosy period. Basically, I would say in the last 15 years, the person who took the most risk made the most money. But by definition, that can't be true all the time, or it wouldn't be risk. And yet, when people go through a very hospitable period and risk-taking is rewarded, it builds up. It's self-reinforcing. Just at the time when you should be reducing it, most people are putting on more. So I think risk consciousness and and knowing what's right for you and your institution, not merely return maximization.
I think a lot of people would listen to this and say, that's all very well, but it's assuming you can distinguish these things. So Sheikh Saoud talked about ignore the noise, but you don't want to ignore the signal, and you somehow have to tell the difference between the noise and the signal. You've talked about risk and uncertainty, but certainly as economist, I consider there's quite a big difference between the two. Risk is calculable, uncertainty is not calculable. It's just a sheer amount of volatility. So for those of us who haven't got an infallible way of telling the difference between these things, how are you confident that you're ignoring noise and not important signals?
I think you need to focus on hard data and not soft data. So I think if you turn off the TV, and I don't mean turn off Bloomberg, but and look at the hard data coming out of the US, the hard data has been coming in very strongly. But investors have been reacting as if it's the end of the world. So what happened in the past month, I think, is quite significant. You went from a bear market to a bull market in 4 weeks. And that's not normal. And that type of behavior meant people were, because fear of missing out is real. That's the emotional part. So people have been buying into a rising market, then selling when things went south. And that means you bought high and you sold low, and you won't be in business investing, buying high and selling low. So, but in terms of signals, I would say it depends on the price that you're compensated on the uncertainty that's there. I think at the beginning of the year, we know there was a new president coming in. We knew about his policy about tariffs, so we knew about a known unknown, so we knew about tariffs. We didn't know what was the impact, so we knew about a known unknown, but we decided to do nothing about it. And I think that's when complacency came in, and some investors paid the price for it.
Howard, how do you distinguish these? I mean, when you say, you particularly emphasize the importance of understanding risk. But are there times when you say, okay, this isn't actually calculable, I don't know what the risk of this investment is?
Well, first of all, we never know the future. And that's where the risk comes in. There was a professor at the London Business School named Elroy Dimson who said, risk means more things can happen than will happen. And it is from the multiplicity of possibilities that the risk comes in. We have to acknowledge that. And, one of my heroes, John Kenneth Galbraith, said that there are two kinds of forecasters, the ones who don't know and the ones who don't know they don't know. And I think it's very important to know which school you're in. But it's our job to deal with uncertainty. We can't run from it. If risk avoidance ends up in return avoidance. We have to knowingly, intelligently take risk for profit. But the definition of the risk we should take is one that we're aware of, that we can analyze, that we can diversify, and that we're well paid to take. And that's basically what I've been doing all my life. And when I started work in 1969, the banks invested in what were called the Nifty 50, and they thought they were investing risklessly in the best companies in America because of the quality of the companies. And if you held those stocks for 5 years until 74, you lost about 95% of your money. And so these people were taking risks they were unaware of, and that's the worst thing you can do. Keynes said that a speculator is someone who takes risks he's aware of, and an investor is someone who takes risks he's not aware of. We want to do it knowingly, not run from it, but and try to emphasize in the long run risks that are tolerable in quantum for us, and hopefully, as Sheikh Saoud says, underpriced.
And something similar happened, I guess, for many people who were holding the developed country sovereign bonds, thinking they were risk-free, going into 22, 23. Sheikh Saoud, okay, this is all very nice, but people will be interested in how it applies to practical decisions you have to make. And one of them came up as we were talking just before we came on the stage. You know, a lot of people are talking about sell America, or at least diversify a little away from America. If you're thinking about whether that's correct, you know, how are you approaching that? How do you think about America as an investment destination right now?
I would say it very bluntly: underweight America at your own risk, because people tend to talk about going underweight the US, and the question is against what, relative to what. They're mainly looking at equity markets, but they're not taking into fact the US has the largest fixed income market, the US has the largest private equity market, the real estate market, infrastructure and credit. Where is all those capital? Where is the capital going? And I think the US has the breadth and depth to sustain its exceptionalism. And it has the rule of law as well. That still applies. So I would reiterate, underweight the US at your own risk.
So does that mean that Kuwait will be joining the list, making commitments to invest in the US?
That's a trick question, but
no, it's a very straightforward question.
It's a very straightforward question, and it goes back to your process and strategic asset allocation. If you developed a forward-looking strategy and put a process around it, you don't need to be reactionary. If you are already there, you don't need to be joining. That's how I would phrase it.
But just because I'm afraid there has been some talk about this, I mean, can we expect to hear an announcement that Kuwait will be joining the countries in this region who are committing to the US, big numbers?
I mean, the US is the largest, I would say, capital markets of the world. So obviously you'd have to be there. And if you want to grow, you have to grow with the US. So naturally speaking, as those capital markets develop, you'd be allocating towards them as well. And we've been allocating to the US for a very long period of time. And I don't think that's going to change.
Yeah. Howard Marks, how do you think about, you'll probably say it's the wrong way to think about it, but how are you thinking about the US as an investment?
Well, look, I mean, the words US exceptionalism are on everybody's lips these days. And, you know, the US has really been preeminent in the world for the last 80 to 100 years, based on dynamic economy, respect for the free market system, respect for the rule of law, capital markets, spirit of innovation, many things. Those things haven't gone away. I think that the U.S. is still the destination of choice, and it is the majority of the world economy. It's hard to imagine that it shouldn't be the majority of anyone's investments. Exactly how you turn that into a number, that's where the judgment comes in, and it can't be the subject of an algorithm. And, you know, the world is going to have to decide whether what I said while we were warming up is that the U.S. is the best place in the world to invest. The question is it still as best as it was? And that's a judgment. Are we as dependable as we always have been? I mean, that every person has to answer that for themselves, and obviously that's a big topic today. But I can't imagine how a large, globally oriented fund could make a substantial reduction in the U.S. Everything has to go someplace. Where would it go? What's better?
So this is but most investors, and I would say this goes across even by scale from the smaller to the larger, would find themselves today disproportionately invested in the US relative to GDP, relative to many other things that you would measure. So if it is at the margin less attractive now than it has been in the last 20, 30 years, just in terms of sort of upside potential, is that something that could affect your overall allocation?
So this is how I would phrase it. So let's theoretically speaking, let's say you would say the equity markets are less attractive. You're going to take capital from somewhere and put it somewhere else. So you might take it from US equity market, but put it into US infrastructure. We might take it and put it in private equity, private credit. So it's still staying in the US, and it might even grow. So the question is just asking yourself the question, where is it going to go to?
And public versus private? How do you think about that?
That's a very interesting question, and I'm going to give you opportunities and risks in both sides of the market. So in public markets, I would identify the main risk is index investing. And the reason I say this is if you go about maybe 10 years ago, the top 5 names in the index made up maybe around 14% of the weight. And because of what maybe Howard described in his memos and sea change, public markets and indexing benefited from beta and liquidity over time. And a lot of flows went to passive. And that generated momentum. And the top 5 names right now make up maybe 30% of the S&P 500. You think that's a big number, but that's not even where the risk is. The 30% are extremely correlated to one another. And it's like adding leverage onto it. So it's like a double whammy. And we've seen how that impacted when the news of DeepSeek came, how the market dropped. And that's a signal you'll pay attention to. And how do you play around it? I would go by saying, I think active management is back. And I think that's how you play around. It might sound counterintuitive, but you would reduce your risk by increasing your tracking error, because you would move away from, you're able to move away from these names. If you look at portfolios of the past, of maybe let's say last year, I just need to know one thing to know if a manager has over or underperformed their benchmark. Did they hold 6% NVIDIA in their portfolio? And that's the only thing I need to know. And in public markets, if you want to compare between debt and equity, it depends on the price and where you want to be in the capital structure. So on average, and over average is a very, I would say, dangerous word to use, but equity markets return 8% over the long run. If you look at what happened in April, high yield, even if spreads were not at historic levels, the all-in yield was maybe around 8%. And you're basically getting equity-like returns, just being up the capital structure. But you have to be ready, and you have to make a decision when that opportunity comes up. So that's on public. On private, it's a whole different story. I believe private equity is very troubled. And I believe, especially in the large buyout, venture capital, and let's say the rise of continuation vehicles, that's a very worrying sign. And private equity is in trouble because they got away of doing mistakes for the past 5-10 years without paying the price for it. And I think their time is coming up. And that's for maybe three key reasons. One is very poor underwriting with no process around value creation, but relying on beta, leverage, and multiple expansion. And in private markets, I mean, we love the GPs that we work with, but when they do something right, they tell you about it and they brag about it. So I would ask LPs to ask their GPs to let them show them their underwriting process and at what multiples have they been buying in their various vintages. And if they refuse to show you, they've been doing something wrong. Because they brag about it if they're doing something right.
What's your exposure now? Is that something, so are you looking to reduce exposure to private equity or just not expand?
No, I would say private equity is a very broad set, and I'll explain later on where the opportunities lie in private markets. I think the risk mainly is in the large buyout and in VCs. And one is poor underwriting. The second part is underwriting with no exit optionality. So when they underwrite a specific deal, they look at one exit path, let's say an IPO. Now, what happens if that market is shut? The third part is size drift. We've been seeing private equity funds grow up in size in time with the same number of portfolio companies. You're seeing them coming up at 10, 15, $20 billion in size. If the base case of underwriting is 2 times your return, it means you have to be realizing $40 billion worth of assets. Question is, who's going to buy them? And the answer is, I don't know. You put them all together, and you have the perfect storm. And this is what we have right now. You have $3 trillion worth of portfolio companies that are yet to be realized. And the worst part of it is they're approaching the end of their fund life cycle. The clock is ticking.
Well, the clock keeps getting pushed forward in some cases.
With continuation vehicle, but there is a limitation. Now LPs are asking for their money back. The clock is ticking, and buyers on the other side are being paid to wait.
You know, I think the thing to bear in mind is that we went through 40 years of interest rate declines. And when interest rates decline, valuation parameters go up, the cost of capital goes down. So the ownership of assets using borrowed money has a tailwind. I've described it as the moving walkway at the airport. It carries you along and you think you're making great progress. But declining interest rates obviously can't go on forever. They can't be the norm forever. And in a stable interest rate environment, like I think we're looking at prospectively, the special returns will go to people who can find underpriced assets and add value. And that's where the reward will be. And that's how the private equity industry will have to distinguish itself in the years going forward, not just buying, levering, and benefited from appreciation.
And that's why you're seeing opportunities come up in secondaries,
right,
and in special situations. Is to provide solutions for LPs and GPs to get out of the problem that they're into. So that's where you're asking, okay, where do you go in private equity? I would say secondaries, I would say, is in a golden window opportunity because of not because of events that are happening today, but because of mistakes that were done maybe 5, 10 years ago, and now they have to pay the price for it. And the price probably is going to be steep.
This is why I'm reminded of my conversations with my teenage daughter as she starts to discover fast fashion. And it's trying to teach her the difference between something being cheap and something being good value. But Howard, on this private-public difference, and I think a sort of related point of liquidity.
Yes.
You know, we talked about indexes. One of the things that has pushed indexes up is it's sometimes illusion of liquidity, certainly the overvaluation of liquidity.
Right.
Now people tend to say, okay, you have to, illiquidity is the price you pay for having a return. Do you think that's still true? Do you think that's where the future is?
Well, in a normal market in which people are appropriately averse to taking risks, and including the risk of illiquidity, there will be a premium for taking it. And so that's a reasonable way to make money, as long as you don't underestimate the need for liquidity. I mean, the worst thing you can do is tie up money that you can't get out, which you might need. And, you know, Mark Twain said, history does not repeat, but it does rhyme. And one of the themes that rhymes from cycle to cycle is that when things are going well, people underestimate risk, and they overestimate their ability to live without liquidity. And when things go wrong, they say, ah, yes, now I understand why they pay you extra to take on illiquidity. You know, what you have to do is you have to be introspective, and you have to realistically appraise your ability to live without liquidity. But liquidity is a real thing, and it's not just a number on a page. There might actually someday be a need for money. Now, you probably don't face it because you have a growing corpus, and it's going to grow for future generations. But everybody has to be at the right place on that subject.
You mentioned, Sheikh Saoud, that the DeepSeek was an important signal to follow. How are you thinking about AI and allocation to that part of the market, to technology?
I think that's a very good question. And I think you can't, I would say, buy AI itself. I think AI is a big theme. I think the question is, how do you get exposure to it, and at what price? So you can either get exposure in owning the companies that develop the technologies, or you can get exposure through the enablers that help AI grow. And I'm going to talk about just briefly the risk-return profile where you're getting it. I think the best way to get exposure to AI right now, maybe even as sovereigns and large allocators of capitals, is investing in the enablers of AI. So investing in data centers, power. Power is going to be the main issue, connectivity. I think those are the main exposures. And going back to what we were saying is you want to compare between owning an asset and lending against it. I mean, even in infrastructure spending, in AI, even if it's classified as equity, the main opportunity is actually in lending. And by lending, I would say, is basically you would go out to a hyperscaler, you'd say, I would build you your data center and lease it out to them contractually speaking. So it looks like equity, but basically you're getting paid on a fixed income instrument by leasing it out. You're getting paid 10, 12, 13% IRRs on a single A, double A rated hyperscaler. That's a great way how to play AI, in my opinion.
Howard, AI?
You know, what I say is I don't think that AI knows everything that's ever happened and how stock prices reacted to everything that happened. So they can emulate the path to success that worked in the past. That's a pretty good skill to have. I believe that AI can't sit down with 5 business plans and figure out which one's Amazon. I don't think they can sit down with 5 CEOs and figure out in advance which one is Steve Jobs. So there are limitations. But of course, most people can't do it either. So I think that just like indexation and passive investing has supplanted much of active management in the large cap stock world, I think that AI will supplant a lot of investing and a lot of investors, but hopefully not the best.
Okay, last question, and you've sort of raised it. Both of you have talked about the mistakes that people typically make, and good investment being about avoiding those mistakes. But I guess good investment is also about recognizing that you too will make those mistakes. So what have you got wrong in the last couple of years?
So I think what you said is absolutely right. And I think it's always about everyone would do something wrong. Sure. You can't avoid doing something wrong, but the important is when you do something wrong is to refine your process along the way. And in hindsight, everyone has 20/20 vision, but no one can predict the future. So you need to focus on your process. But I would say two key takeaways for a long-term investor is that it pays off to actively decide to be patient. And sometimes the best investment decisions you make are opportunities you don't pursue. I would put it that way.
But what have you got wrong?
What have we got wrong? See, we've been around for 72 years. So,
and you made no mistakes?
We always make mistakes, but we learn from them. And I think it goes about sometimes you need to keep refining your process, and sometimes you get carried away when things do get right, that you think you're getting them right, but you don't know if it's luck or skill. And I think as now, the easy time of making money is over. You need to keep refining your process the whole time. I think that's what we've been focusing on. I mean, I'm privileged to have a great team working with me, and we've been focusing on process a lot. And I think that's the key thing. People tend to forget about process when things are going right, and they tend to panic when things are going wrong. If you keep your process there and have a playbook and a game plan, you should be ready when the opportunity comes. And I think, to be honest, as the KIA, we've always been ready when things went wrong. I think we've been great beneficiaries of the financial crisis. Maybe we've learned from our mistakes on .com, but in the financial crisis, the KIA played a big role in bailing out the financial services industry. And this man as well has made a lot of money in the GFC. Okay. So I think there's a few things we have in common.
We've not had a concrete example. Well, maybe 25 years ago in tech is the last time you made a mistake, is by the sounds of that. But Howard, very briefly, we're getting shouted at to leave. But where have you, what have you got wrong?
Well, you know, look, we all have our biases. We can't escape them. The most important thing is to understand them and limit their effect. I am a conservative person, and I'm a skeptic with regard to new and not obviously meritorious developments. So that hasn't been a good thing in the last 15 years. That would have held you back in the last 15 years. So I've had to suppress that. And, I can't always do it perfectly.
Okay.
I still think those are good values, but sometimes they get in the way.